Hi, Dr. Chan. This is Sophian from the 1 p.m. section, and we are Group 12. American Guitar Company currently uses absorption costing with normal costing. Under absorption costing, product costs are usually capitalized to inventory on the balance sheet, including all manufacturing costs, which are direct material, direct labor, and both variable and fixed manufacturing overhead. Variable and fixed selling and admin costs are treated as period expenses and appear on the income statement.
Hi, I'm Kimberly, and I'll be talking about the proposed internal costing system. We propose that American Guitar Company use variable costing to evaluate performance internally. Variable costing assigns direct material, direct labor, and variable manufacturing overhead as product costs. Fixed manufacturing overhead, along with both variable and fixed selling and admin costs, are treated as period expenses and appear on the income statement. American Guitar Company must continue using absorption costing for external purposes as required by GAAP and can choose between actual, standard, and normal costing to assign product costs.
My name is Daniel, and I'm also in Group 12. I will be talking about the effects of variable, normal, and standard costing on financial reporting. Normal costing tracks inventory costs by applying actual direct materials and labor hours while using budgeted rates for allocating both variable and fixed manufacturing overhead. Variances occur when actual and budgeted overhead amounts differ. Large variances are proportionately split between cost of goods sold, work in process inventory, and finished goods inventory, affecting both the income statement and balance sheet. Standard costing tracks inventory costs based on estimates of all manufacturing costs, direct materials, direct labor, and both variable and fixed manufacturing overhead. Material variances are closed proportionally to cost of goods sold and finished goods inventory, affecting both the income statement and the balance sheet. Variable costing assigns only variable costs to inventory, including direct materials, direct labor, and variable manufacturing overhead, while fixed manufacturing overhead is treated as a period cost and expensed on the income statement. Operating income appears lower under the variable costing than absorption costing, since fixed manufacturing overhead is expensed rather than capitalized inventory. This, however, provides management a more accurate view of costs, since the fixed costs are independent from the production volume.
Hi, I'm Desiree, and I'll be talking about the effects of variable, normal, and standard costing on performance evaluation. Under normal costing, variances only occur in manufacturing overhead, since it is the only allocation based on estimates. For this reason, management is only able to evaluate performance of costs relating to manufacturing overhead. Variances of manufacturing overhead indicate whether costs are being kept under control. The purpose of the standard costing system is to estimate the cost of a product in the beginning of a period and to control costs by encouraging employees to keep costs and performance in line with management's budgeted objectives. Since budgets are used for all manufacturing accounts, the adjusting entry to account for the variance between actual and budgeted allows management to evaluate the overall performance for the period. Additionally, management is able to evaluate information regarding price changes, pricing efficiencies, and the use of material through the price and efficiency variances. By having details of these variances, management is able to focus on the causes of variances to more effectively control costs in the future. Variable costing produces an income statement emphasizing contribution margin, which is calculated by subtracting all variable costs and period costs from revenue. This is useful to management in identifying how much individual products are contributing to overall profits, determining break-even analysis, and the future needs of business expansion. Absorption costing, using either normal costing or standard costing, produces an income statement emphasizing gross profit, which is calculated by subtracting all product costs from revenue. This is useful in analyzing the efficiency of production costs and setting pricing policies.
In conclusion, we recommend that American Guitar Company uses variable costing for internal reporting purposes, because this method analyzes only costs associated with production volume, giving an accurate view of dependent costs per product. Fixed costs are independent of production volume and will be incurred regardless of production. We also recommend American Guitar Company use absorption costing with standard costing for external purposes. Standard costing estimates all product costs for a given period, allowing management to compare budgeted to actual and focus on the evaluation of variances for future cost control. Thank you for listening to our presentation. I hope you enjoyed it.